Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 106. And Richard is back, which is great news. And before we get into it, he will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Well, we have a packed week this week, Richard. There's a lot going on. We've got a lot of data. So first of all, the news. The latest economic data from the US confirmed that the US economy is doing quite well. So retail sales bounced by plus 3% month on month in January, much better than expected. And the big data point this week was US inflation, which continued to decline, but not as much as expected. And services inflation appears to be sticky and persistent. And yesterday we had US producer price inflation, and that was very surprisingly strong, up plus 0.7% month on month. So inflation in the US appears to be persistent, and that has led to a rapid rise in bond yields over the course of the last 2 weeks. We will take you through it. Russia has announced plans to cut its oil production by 500,000 barrels a day starting in March in response to EU sanctions. And as a reaction to that, the US has announced that it will release a further 26 million barrels from the Strategic Petroleum Reserve. You'll know that recently the US has halted sales from the Strategic Petroleum Reserve. Well, now they're going to start again. And that is despite an enormous oil inventory build in the US of 19.2 million barrels this week. So really, the US doesn't need to release any oil from the SPR because it seems as though the US oil market is very well supplied, in fact, oversupplied at the moment. In other news, the US has shot down, I think it's now 3 UFOs over Alaska and northern Canada. Is intergalactic warfare the next exogenous shock, we ask on this high-quality podcast? And finally, the FTSE has topped 8,000, which continues to defy my expectations and the economic slowdown. The FTSE has had a very good start to the year.
Keith, I think we should all go away and re-watch the Predator films so that we're prepared for the landing.
Yes. Sharpen your kitchen knives. So this is the US Strategic Petroleum Reserve, which the Biden administration has run down enormously over the course of the last year. And it's now announced it will release another 26 million barrels. That is bearish for the oil price. Now, the FTSE 100 has at last topped 8,000. Amazingly strong performance since the start of the year. And very much against my own expectations, as the world economy is not very strong, struggling, interest rates are rising, and we're expecting recession the second half of the year. This is its long-term performance, which is very poor compared to the rest of the world. Essentially, since 1998, the FTSE 100 is flat, whereas the World ex-UK equity index has trebled. And that is partly due to its high commodity weighting, and that is why the FTSE 100 is currently doing well. Commodity producers have had a good bounce on the back of hopes for Chinese reopening. The market has reappraised the outlook for US interest rates in light of the strong US economic data. So you've had a big rise in interest rate expectations over the next 12 months. So this is December 2023 Fed funds futures, and you'll see they've risen by over 50 basis points in the last couple of weeks. And the whole yield curve has shifted rapidly upwards. The market has seen the strong economic data and has repriced the whole curve upwards. Now, I expect that to continue until we get some weak economic data, and then the whole thing could reverse just as quickly. Okay, on to this week's economic data, and I'm afraid there is a lot of it. We've had a big data dump, so I will go through some selected items. So first of all, we had UK GDP. Year on year, that hit expectations, down 0.1%. Month on month, December was minus 0.5%, well below expectations. UK industrial production was better than expected at only minus 4% year on year, as expected at minus 5%. Construction output continued to fall, up 3.7% year on year, down from November, but better than expectations. Now, good news was that the UK continues to create jobs. So in January, the claimant count fell by 13,000, and that was actually a bigger decline than December, whereas the market was expecting a rise in unemployment. So the UK economy, although it's shrinking, is creating jobs. Average earnings in the UK fell in December to plus 5.9% year on year, down from November and below expectations. And that is very good news. So the wages are rising, but less than inflation, and there's no sign of a wage price spiral. The HMRC payrolls count for January showed an enormous rise of 102,000, well up on December and twice expectations. So further evidence that the UK is continuing to create jobs. Now, we also had UK inflation numbers. CPI came in at 10.1% in January, down on December and below expectations. Now, last week we were talking about how the NIESR, the National Institute for Social and Economic Research, was expecting UK inflation to bounce up in January and then fade quickly from February onwards. Well, they were wrong. January inflation declined, and that is great news. If they're right about inflation now falling from February onwards, we could see inflation falling back from its currently very high 10% towards 2% quite quickly. Now, we've got some charts later. Month on month CPI was minus 0.6%, well below forecast, and in December it's plus 0.4%. So inflationary forces seem to be fading quite quickly in the UK. Core inflation came in at 5.8%, well below expectation and well down on December. And core CPI came in at minus 0.9% month on month. So the inflation outlook in the UK appears to be good based on January's numbers. Inflation is fading quite quickly. Now, we also had some Chinese data. I've only included one data item because I thought this was really interesting. So Chinese vehicle sales year on year were expected at minus 10%. But in January, it came in at minus 35%, an absolutely enormous drop. So there is as yet no sign of that big bounce in the Chinese economy that everyone is hoping for. And then we had lots of US data. So first of all, we had the University of Michigan surveys of US consumers, and they showed a bounce. So in February, consumer sentiment bounced to 66.4, up from January and above expectations, but really not a huge rise. We'll show you the chart in a second. Current conditions also rose and were above January and above expectations. Inflation expectations, though, also rose, and that will concern the Fed. We then had, and this was a big data point for the week, US inflation, and that was disappointing. So in December, it was 6.5%. It was expected to fall to 6.3. It didn't. It fell to 6.4. So inflationary forces in the US are more persistent than the market was expecting. Month on month, inflation came in at 0.5%, above expectations. Core CPI was expected at 5.4, came in at 5.6. So again falling, but again not falling as much as the market anticipated. We also had retail sales numbers in the US, and they were strong. Year on year, 6.4% above expectations, but the big number was month on month. That was expected at 1.2%, bounced by 3%. Now, annualized, that's a lot. There's a big bounce in US retail sales in January. We now have two entirely contradictory manufacturing indices. The New York Fed Empire State Manufacturing Index bounced enormously in February to minus 5.8, well above expectations, whereas the Philadelphia Fed collapsed. It was expected minus 7. It came in at minus 24.5. So we're getting lots of contradictory data. The NAHB Housing Market Index had a little bounce in February at 42, up from January and above expectations. Now, and yesterday we had producer price inflation, and that came in above expectations. So month on month in January, it was plus 0.7, not good. We also had some quarterly data, and the big news for the UK was that Q4 GDP came in 0, which was better than expectations of a decline. So the UK has avoided a technical recession. Now, one thing I found really interesting was the business investment data, and that showed a real surge in business investment in Q4, which goes totally against my expectations, rising 4.8% quarter on quarter and year on year at 13.2%. All good news. But construction orders fell by 4.3% in Q4, although that was above expectations. Some charts, Richard.
Thanks so much, Keith, for going through that. So there we have the decline in UK GDP, which is sort of really bouncing around 0 for the last year.
That's December number as well.
Yeah. And the year-on-year growth is at pretty much 0. So the economy has stalled. Quarter-on-quarter annual growth rate. I mean, the whole thing is looking very sick, really. And there's our CPI, which has just fallen back from that peak of 11%. And the month-on-month figure showing that decline. And the core CPI basically mirroring CPI, just down a little bit from its peak. And the RPI year on year, what used to be the old inflation measure, it is not good at all.
Yeah, and you notice that RPI was actually flat month on month.
Yeah, exactly.
I have a section coming up on the differences between RPI and CPI.
So the UK claimant count, which is falling. Our UK employment is looking quite strong. I was listening to a webcast actually, and the guy was saying in 2008, employment was falling, but GDP didn't roll over. And so everybody said there's no recession coming. And now GDP appears to be rolling over, but employment isn't. And everybody's saying there's no recession coming. Yeah, these things are complex, and you can't accurately predict on the basis of one thing, but it just gives you a sense of what might be going on. But it is much more complex than taking one element and saying this is indicative of what's happening. UK average earnings, as Keith says, they appear to have flatlined, although we've also got these big increases being bid for by health sector workers, ambulance drivers, possibly teachers, train drivers. So I'm not convinced that this is, and they're a big chunk of the working population. So I'm not convinced that we've seen the last of this. There's the payrolls count, as we just discussed. And the balance of trade is looking very sick. Presumably, Keith, a lot of that is energy imports still.
Yes, that's December numbers. So yeah.
And the long-term balance of trade is, it's taken a step change for the worse, hasn't it, since the beginning of 2022?
Yeah.
And industrial production, I think UK industrial production is in a long-term downtrend. And this is just a snapshot of the last 12 months. Construction orders, quarterly data. I mean, I would be expecting construction orders to be worse than this. I wouldn't be surprised if the next quarter we see a figure that is less than minus 4.3.
Yeah.
And likewise, I would not be surprised to see UK construction output falling. Although when you look around London, which clearly is a huge driver of total UK construction, the amount of building that is still going on in London is extraordinary to my mind.
Yeah.
Maybe there are people finishing off projects that they have no choice but to finish.
Well, absolutely. Takes a while, to finish orders.
EU industrial production, whilst it's down, it's nowhere near the UK figure. And if you look at they've had bumps up in industrial production, whereas the UK industrial production is incontrovertibly only falling. EU balance of trade deficit due to energy, and the Michigan Consumer Sentiment Index looking a little bit positive there.
Yeah, still poor, but well up from its lows.
Yeah. Current conditions index looking very similar actually in terms of the shape of the graph and the positioning. 1 year inflation expectations. So I mean, if you look at that, they've gone from 2.5% to 5.5%, and now they're around about 4.2%.
But it's that little bounce that is going to worry the Fed.
Yeah. And the 5-year inflation expectations. I mean, all you can really say about the 5-year inflation expectations is that they were wrong.
Yes.
National Federation, is that independent businesses?
Yes, small businesses in the US.
Yeah, a little bit less optimistic than neutral.
Yeah, little bounce in January, but still poor.
Yeah, not great. And the US State Manufacturing Index below zero, but it has moved up. But the trend is clearly downwards still, as is with the Philadelphia manufacturing. That's actually a clearer downtrend.
Yeah, but really contradictory information. One bouncing strongly, the other collapsing.
Or not, yeah. Then we have US industrial production, which is basically heading towards zero. Building permits seems to have leveled off at pre-2020 levels, roughly speaking.
Yeah. So in absolute, it's down a lot, but it's still a pretty high number.
Yeah, that's exactly so. And housing starts down a lot, the same thing, but actually above pre-COVID levels.
Yeah, but falling quite quickly now.
Yeah. So there's a month-on-month housing starts falling. US CPI still falling from 9% down to just above 6% now. And monthly CPI, I mean, my view is that CPI is simply not going to go back down to whatever the Fed says it's going to go down to. I suspect that, I genuinely feel that we need to be prepared for inflation to bounce up, stabilize at a much higher level, but not do what these charts of hope do, just take it back down to 2%.
Well, I think that's where you and I differ, Richard. And I think that the Fed is committed to getting inflation under control and is going to continue raising rates until it does. And that will mean a recession. Now, in the case when a recession hits, inflation will absolutely collapse. But the moment we come out of recession, it'll come back.
Yeah, although there have been past recessions where inflation hasn't collapsed at the start. It's fallen over the course and really hasn't really started to move till towards the end of the recession. So I just think that from a point of view of managing one's investments, needs to adopt a a non-dogmatic view of what's going to happen to inflation.
Well,
I'm saying you're dogmatic, Keith. Let me understand.
yeah. I mean, the thing is, Richard, I've been expecting inflation. Well, inflation has come down as I've been expecting, but bond yields have not.
Yeah.
And so my cyclical trade is not working currently.
And the other issue, I mean, we don't get too bogged down in geopolitics right now, but Russia is undoubtedly going to be launching a new offensive into Ukraine. The West is running out of munitions that it is willing to give to Ukraine because it's depleting its own defensive stores. And that makes Ukraine, I think, very unpredictable. And if Ukraine is unpredictable, what happens to energy prices becomes unpredictable.
Yeah.
In fact, what happens to world peace becomes unpredictable.
No, well, I agree with that. Yeah.
So there's US core CPI, which actually is stabilizing, I would suggest, at 6%. In other words, it's reached a peak and it's not, and it is now plateauing.
Well, I think the data is very volatile. We just have to see what happens month on month.
Yeah. But PPI, which is the cost inputs into manufacturing industries, falling sharply and continuing to fall.
Well, is it?
Okay, but it's ticked up here. Yes. Okay. So the theory is very much out, really, isn't it?
It is.
What happens from this point forwards?
Yeah. The thing is, the monthly data is volatile. Year-on-year data includes, lots of historic numbers. So it depends on, what rolls out of the window.
Yes, that's very true. Red Book retail sales, they are on a downtrend.
Yeah. And you see, we have had this bounce in the January numbers, but
tiny bounce, isn't it?
Well, sorry, this is weekly data, Richard. So we had the January numbers, and yes, that's this is all consistent, but it's showing that retail sales have since drifted off a bit.
So you have retail sales year on year, which actually been quite healthy, although as Keith just pointed out, the more recent weekly data isn't so healthy. Retail sales month on month.
Yeah, that's a big number.
Yeah. 30-year mortgage rate. Is it going to stabilize at around about 6%? Question mark. Or is it actually going to go higher if the Fed continues to hike?
It's going to go higher. We've got a section on US housing coming up, and we will talk then about 30-year mortgage rates and how dependent they are on bond market volatility, which is something I hadn't previously known.
So there we have the US MBA mortgage market index, which declined significantly from early 2022 and basically looked like it stabilized late autumn last year. And that's the 25-year view, where you can see there's been this almost not unprecedented, but it's a very big drop since 2021.
Yeah, so I think there's a big contradiction here between the mortgage market index, which shows total mortgage market activity, and the construction activity, which remains quite strong. Yeah. So you're going to have all these houses coming off the market. Who's going to buy them?
And which we've discussed, the builders are frantically trying to complete their houses in stock, housing in construction, to get them onto the market.
Yeah.
So there's the NAHB housing market index, which has had a little bit of an uptick recently, but is pretty weak.
Yeah. So this is how house builders feel about the market. And so there's been a little bounce in January.
Yeah. US initial jobless claims, pretty low.
Yeah, refusing to rise.
Yeah. And continuing jobless claims have risen since September last year.
So I think what this is showing, the way I read it, is that companies are not letting people go, but they're not hiring much either. So if you're out of work, it's quite difficult to find a job. So continuing jobless claims are elevated.
That's a good point, Keith, actually. And that makes sense of this data. China vehicle sales haven't yet recovered. I mean, they only really came out of lockdown, what, two months ago? So we shall see. So it's really very interesting. I listened to a very interesting webcast, and the guy was saying that China hasn't had a recession since Tiananmen Square, and that Chinese policymakers will be desperate to avoid a recession because basically Tiananmen Square looms large in their minds.
Right. Well, we've got a section on Chinese residential investment coming up.
They're going to struggle, really, aren't they, Keith?
I think they are.
But yeah.
Yeah.
And there's the Chinese yuan loan growth, which has sort of plateaued. We may be ticking up, may not be. A little bit more data needed there. And what is total social financing, Keith?
Well, total social financing is Chinese government stimulus, basically. And it shows they're trying to pump money into the economy again.
Yeah, because they're desperate to avoid a recession.
Yeah.
Chinese new home prices year on year. So clearly they had significant 5 to 10% annual house price inflation, and now that is going slightly negative.
Yes. House prices everywhere, always sticky on the downside.
Yeah. Because people won't sell them for less than they paid for them until they're forced to.
Yeah.
So what have we got? We've got some conflicting numbers, but there's a general trend which is movement is slow. So if we're expecting a recession, we're certainly moving it into it slowly. And economic activity bounced in January, as did consumer confidence, but it's not great. Labour markets do remain tight everywhere, which is a sort of confounding factor, really. So inflation does seem to be sticking around, and I personally expect it to stick around. And as we would anticipate and have said in the past, the construction sector is slowing down. And that, as we have also said many times in the past, is a leading indicator for a recession.
Yeah. Yes. Thank you, Richard. Okay, on to one chart. And this is what I've got wrong, basically. So this is a cyclical costs conditions index, and it is showing essentially record tightening. So we've had very fast increase in interest rates, plus we've had rises in gasoline and oil prices and the US dollar over the course of last year. But there is a lag around 15 months between the cyclical cost condition index and economic activity. And now my assumption was that because the world economy was so indebted, it would be very sensitive to rises in interest rates, but that has not been the case. The traditional lags in the economy remain in place, but I fully expect over the course of the coming months, this record tightening to slow the economy and bring inflation down. As inflation comes down, so will interest rates.
I think it's a really interesting chart here, Keith, actually. I think it's fascinating. And the depth of the conditions index, the depth to which it has fallen is extraordinary, isn't it? It's astonishing. I mean, it's significantly lower than the COVID crisis. I just think about what you said with the effect of interest rate rising. I mean, I think I suspect there's an exponential element in terms of sort of non-linear element in terms of how much interest rates have to rise to start to have an effect. And I also think there's a non-linear effect of even if for a specific interest rate rise, the number of effects that you see is also non-linear over time. And if we are in two elements of the slowly sloping, gently sloping non-linearity of those effects, and we're moving into the more exponential element in both cases, at some point, there is going to be an almighty bust.
Well, frankly, Richard, that is my expectation. But actually, I would say that we don't know how this has been put together. And I also think that the window that's been chosen is quite specific in that, this is the period in which interest rates have generally been in decline and interest rate rises have been gradual. If this has been extended back to like the late 70s, I think this would not show record tightening, because record tightening would have been then. But still, you know.
I would like to see this go back to, as you say, back to maybe mid 1960s to get a real feel for how we compare to the 1970s.
Yeah. But still, I think the point is that business conditions have tightened a lot.
Yeah.
So in summary, there are very significant time lags in the economy because projects and commitments that have already been started need to be finished. And existing fixed rate debt is unaffected by rising interest rates. So it's only when you come to refinance your loans that rising interest rates really affect you. So there are time lags between tightening economic conditions and the real economy of around 15 months. And reminder, the Fed only started raising interest rates from effectively zero in March last year. So those tightening interest rates have really not affected the economy much yet. And actually, we've got a really interesting chart from the Chicago Fed showing that. But over the course of the next 6 months, they will. And on to inflation watch, Richard.
Thank you, Keith. Relatively good news in the UK that both CPI and core CPI fell in January, likewise for the US, although from a relatively uncomfortable level. Whereas in the EU, we had a flat January inflation figure, and Japan's inflation was significantly up in December. And in terms of where we are with central bank tightening and easing, we've got QT in both UK and US. And in the EU, we have net QT, but the transmission protection mechanism, which is designed to stop the spreads in bonds between the Germany and southern European countries from becoming outrageously large, in other words, to support the debt markets of the southern European countries. And in Japan, bond yields are still at 0.5%. So this is a chart which shows the revised and original CPIs for the US, and actually they're remarkably coincident, aren't they?
Well, I mean, the point is, Richard, the red line is from the latest data, and they've revised up their estimates for CPI in both November and December. So, yeah, it all adds to a general picture that inflation is actually more persistent than we thought 2 months ago.
Its transitory stickiness is no longer as transitory as we thought it was.
Yes.
And this is showing that services inflation has also been revised up, and it's shooting up, actually, isn't it? It's a very, very volatile measure over this month on month. So there was a revision of the annualized core CPI from 3 months December to 4.3% from 3.1%, which is a chunky revision.
Yeah.
And 80% of CPI inflation over the 3 months of January is coming from shelter. Now, we've discussed shelter and how that's lagging because of the way the Fed measures it. So for shelter that should have increased previous inflation figures and would have made inflation high is now coming through and stopping the true figure for inflation from falling. I mean, it's swings and roundabouts, isn't it? It's adding 3% to CPI year on year at the moment, which is a lot.
Yeah.
And because of the way they do measure shelter and the fact that the measure is lagging, it is a drag on disinflation as measured by the measurements that they use.
Yeah, so I thought this was interesting. So goods inflation has absolutely collapsed. Service inflation is sticky, but, rents is higher than anything because of this lagging effect. And we know actually that rents are collapsing. So
shelter prices do, to an extent, follow the Case-Shiller house price index. And clearly the Case-Shiller house price index has fallen sharply over the last few months. So you would expect shelter to follow. the rate of inflation of shelter to follow that of house prices. And the median asking rent has fallen from the peak just, and it's just below that peak. So yeah, our US rent's probably now beginning to decline. And we can see there the rate of rental growth year on year has dropped from 17.5% a year ago to 2.5% now. But we have this, so we're expecting house shelter inflation to fall. We've got goods inflation, which has fallen, and we have services inflation, which is not falling.
Yeah, I thought this was really interesting. 3-month annualized, 6-month annualized, 12-month change are all very similar. It's just not coming down.
Yeah. And services is a big part of the US economy, obviously. Wages is a big factor in service industry cost. And if wages continue to rise, service inflation will stay high.
Yeah. And so the Fed needs to create some slack in the labor market to reduce wage inflation to get inflation down.
Yeah. And there we have a chart that shows goods versus services inflation and the difficulty the Fed now has got in trying to target the appropriate sector of the economy. This is showing that median prices have hit a new high recently, which means that disinflation, i.e. the dropping of inflation back to 2%, the arbitrary 2% target, which originated in New Zealand.
Yes.
By some economist, the arbitrary 2% target is a long way away. And US wage growth remains high, and it's 6.1% in January, which is unchanged from December. So it's sticking at that level. And wage growth in core non-housing services is declining rapidly. What does that mean?
Well, the White House have produced this new measure of earnings growth, Richard, which you'll be unsurprised to learn, shows wages falling more rapidly than the other measures.
Just drivel, Keith. I mean it. I mean, I think it's something that has just been produced. Let's find a graph that shows that. It's like one of these spurious correlations. Let's find a graph that shows what we want it to show. And what on earth is housing services and core non-housing services? And what's non-core non-housing services? And what's non-core housing services? What do I mean non-core, non-core housing?
You can see what they're trying to do. They're trying to show that service sector wage inflation, which all the other measures are showing is persistent. They're trying to show that actually it's coming down.
Right.
We leave it there and move on.
So we had the people were moving jobs because they got a pay rise when they moved jobs, and that is diminishing now. So if you want to move a job, you might not get a pay rise anymore.
Yeah,
which makes it more likely you won't move.
Well, it's still a decent incentive to move job. You're talking about, so average growth in wages advertised in job postings is the black line, and it's on the left-hand scale. So you're still talking about 6%. Not as good as it was 9.5%, but still all right.
Yeah, that's true. And what's the biggest contributor to CPI? Energy was a big contributor, and we can see used car and truck prices have dropped substantially, so they are disinflationary at the moment. Transportation, which presumably is very dependent on energy costs, are also quite high. So we've got fuel oil and piped gas, very big contributors. There's some fairly, food at home, food away, pretty large contributors as well. And as we have sort of been commenting just now, the San Francisco Fed is suggesting that rate rises haven't really yet had an impact on the economy. And the question is, should we wait and see if they do now, or should you raise rates again? And wait and see if they do. You don't know whether it's, if you raise rates again, you will have an impact on the economy. You don't know whether it's going to be but you'll be taking a sledgehammer to crack a nut, proverbially.
Well, this is the traditional problem with monetary policy. You're driving the car only looking in the rearview mirror, and you inevitably over tighten because there's this enormous lag. You tighten, nothing happens, so you tighten some more, and then when it does start to work, it is too late. The economy is bound for recession, and frankly, I think that's absolutely what we're going to have in spades this time, because we've tightened monetary policy really quickly. Now, currently, it's not having any effect, but I think this is an incredibly important chart. What it shows is that there are big lags, and it's had no cyclical effect at all so far, but you know it will.
Yeah. No, I completely agree, Keith. I think they're they're in such a hurry to I mean, they got knocked off their perches, didn't they? Central banks got knocked off their complacent purchase of, we have inflation under control. There is no inflation. Everything's fine. And bang, their credibility was destroyed, in fact, in terms of their ability to manage inflation. And I think it pretty much showed the degree of control that central banks proclaimed they had over inflation was illusory. Yeah. And now they are desperate to try and regain the credibility that they've lost.
Yep.
And I suspect that in so doing, they will overegg it, as you say.
I think it's inevitable they overegg it precisely because of the lag shown in this chart.
Yeah. And then you come down to the question, what is a central bank for, apart from regulating the banking sector? And I'm not going to answer that one specifically, but I think there's a debate to be had.
I think we know what you think, Richard.
So there we go. So far, the current inflationary episode is tracking historic ones. Expect it to continue to fade over the next 2 years. I would just put a question mark at the end of that.
No, I think it's going to fade quite quickly. I think high interest rates will kill the economy. Look, so far I've been absolutely banging the gong on this for 6 months, and I've been totally wrong. But I still, you know, we cover this every week, and the leading indicators are slowing. We know the housing market's slowing, and that leads the economy down. Now, that chart from the San Francisco Fed, I think, is really important. You know, monetary policy hasn't had any effect yet. When it does, you know, we've had very sharp tightening, then I think the economy slows, and that brings inflation down, he says. Fingers double crossed.
We shall see. I mean, I'm not saying you're wrong, Keith. I'm absolutely not saying you're wrong. I'm a little bit more cautious in my prediction.
Well, yes. You're sensible, Richard. That's the difference between the two of us.
So we have the inflation is a monetary phenomenon. So there is this equation, isn't there? MV.
PQ equals MV.
Yeah. Sorry, what was it? P equals MV.
PQ equals MV.
Yeah. So the price times the quantity of transactions equals the amount of money times the velocity with which the money circulates in the economy, effectively. So, but the velocity of the velocity is calculated from that equation. So the wise economists say that velocity is x, the quantity of money is y and falling, and therefore p has to fall. But of course, if velocity increases, p doesn't need to fall at all. So yes, we've got a definite shrinking in the money supply, but if velocity increases, then inflation doesn't change. So I'm merely pointing out that one of these numbers is a derivative of the other.
Yeah, no, I agree. But velocity, you know, velocity of money is a function of people's propensity to spend and credit growth. And actually what you tend to find is as the economy slows, velocity of money also slows.
But beware people who say that velocity of money is anything other than something calculated from the quantity of money.
Yeah, and also velocity of money, you know, one of the monetarist view was that velocity of money was stable, and it ain't, you know.
So EU core inflation should peak this quarter. So we have the headline inflation in black. The grey area is the forecast area. And quite intriguingly and unusually, actually, the dotted line, which is the forecast line, comes off the black line at approximately 90 degrees.
I know.
Have you ever seen that before, Keith?
You should be a forecaster, Richard. You have a ruler. That's all you need.
And this is a chart put together by a 3-year-old child with a box of paints.
Well, I find this absolutely astonishing, actually. So this is from the ONS and the Office of Budgetary Responsibility. And they're forecasting UK CPI to go negative in 25-26.
So, Keith, I only have I have two observations on this chart. I think that for someone who finds too much information on the chart confusing, it's a little bit, what's going on here? Yeah. The second thing is, I just think that black line's a bit steep. They've got it at about 70 degrees. It really should be coming off at 90.
I think you should write to them, Richard, offering your protractor.
Yes, they're using some sort of different measure, aren't they?
Well, I very much hope they're right, but I'm skeptical.
They're using a central banker's protractor, which measures degrees in the way to everybody else. Oh, shrinkflation, 44 grams to 50 grams. And well, there's a surprise, isn't it? But it's a big difference. It's a 10%, more than 10% reduction.
Yeah.
11% reduction. And that's 11%, that's 11% inflation. Even if it has remained unchanged, which we all know it hasn't.
Yeah.
So, to summarize, Richard is a skeptic. But seriously, inflation in the US is falling, but service sector is remaining high and looks like it might be persistent. And wage inflation is high, although it's falling off. Shelter inflation is actually causing a distortion to the CPI in the US because of the way it's measured, but it is dropping quite fast. And we would expect it to drop. And UK inflation is falling and expect to start falling sharply in the coming months. Well, you know what our view is on that, on my view. But so I would say that there are external factors that could severely damage all of these projections, and could render this discussion that we've had obsolete, and they relate to geopolitics and world events.
Yes, it's true.
Well, I think it's a very dangerous situation which is now developing in Ukraine. And there's our bottom line, and US, particularly the bottom bullet point, US rates to remain higher for longer until the economy starts to weaken, but which may well cause the economy to hit the buffers.
Yeah. Okay, thank you, Richard. Now, in the UK, we often talk about what the difference is between the different inflation measures. And I'm currently working slowly on the Beginner's Guide to Bonds Part 3, which is inflation-linked gilts. And it's important to know the difference between the two. Now, RPI, this month you'll notice that RPI was flat, whereas CPI fell. And this is a statement from the ONS. Overall, RPI is a very poor measure of general inflation, at times greatly overestimating and at other times underestimating changes in prices and how those changes are experienced. In 2013, so quite a long time ago now, the RPI lost its status as a national statistic. Our position on the RPI is clear. We do not think it's a good measure of inflation and discourage its use. However, index-linked gilts are still indexed to RPI, and that formula hasn't changed. Now, what is the difference between the two? Well, the first one is that RPI is calculated using the arithmetic mean, which is the method of calculating the average we all learnt at school. And that essentially assumes that consumers keep to their preferred consumption basket no matter what the changes in price. So if you prefer carrots to turnips and turnips halve in price, you continue eating carrots. CPI is calculated using the geometric mean, and that assumes that consumers will switch to the cheaper good. So as turnips halve in price, you decide actually you'll start consuming more turnips. And that is generally how consumers actually behave. Now, there was some controversy about this, and an assumption that's used in CPI is that you will switch to the good that has experienced the lower inflation no matter what its absolute price was. So in the box at the bottom, we talk about how if Toblerone is priced at £1 and Cadbury's Dairy Milk at 50p in year one, and in year two, the Toblerone increases in price less than dairy milk, although still remaining much more expensive than dairy milk. The assumption is in CPI that you'll start consuming more Toblerone, even though it remains more expensive. Now, Dr. Gareth Jones said that is not how consumers actually behave. They won't switch to the more expensive good, whereas Dr. Michael Scholar, who's actually on the panel, basically said, yes, it is. Actually, people prefer Toblerone because it's more expensive. The fact that Toblerone is more expensive reflects the fact it is higher quality, and that higher quality has just become cheaper, so people will switch to it.
So Michael Scholar clearly earns too much money. I mean, it's nonsense.
Really?
It's one of my problems with this, with the way that inflation is measured now, is this so-called hedonic adjustment circle, isn't it?
Mm.
It's nonsense, and you take, yeah, I mean, it is counter. It's not only is it counterintuitive, it's not the way people behave. So Michael Scholar may behave that way, although I suspect his drivers are somewhat different, but it's not true.
Well, I think this is a philosophical argument, Richard. It's I don't know actually.
So I think if you take a family of five, 3 children who the children eat some chocolate, and the price of the chocolate bar goes up. And the family of 5 is on a very constrained budget. Is the family of 5 going to switch to Toblerone? Of course they're not. I mean, it's just nonsense.
Well, I disagree with that. Look, okay, let's ignore chocolate. Let's talk about like steak.
Right.
Let's say fillet steak is a tenner and rump steak's a fiver, and in year 2, rump steak is £8 and fillet hasn't changed. You'll eat more fillet, won't you?
No, you won't. You just stop eating rump, because we're talking about people who have constrained expenditure.
Well, yeah, no, we're talking about the entire country here.
Yes, but a lot of the entire country are people with constrained expenditure.
Well,
and this is predicated upon a particular strata of person who might make that decision. But a lot of, and this is why we have this argument about, well, what inflation is a person actually experiencing? For someone who eats chocolate and hasn't got very much money, in this example, they're experiencing 20% inflation, not 5% inflation.
Yeah.
So I think it's completely wrong. I'm very
okay. Well,
very interesting to see it sort of in black and white.
Yeah. Well, this is the reason that CPI is lower than RPI, and that's the philosophical underpinning.
And it's, as with my cynical mind, it's the reason we have moved to CPI, because it makes the job of politicians and central bankers easier.
I don't disagree with that. There are other differences between RPI and CPI. And actually, a key one is that RPI includes mortgage interest payments. And that creates a feedback loop whereby high inflation causes the Bank of England to raise rates. And that actually causes RPI to rise as well. So the new CPIH, which index-linked gilts will start to index to from 2030, includes housing costs, but includes market rents, not mortgage interest payments. And I think that's quite an important change. RPI also includes council tax and other housing costs.
So, I mean, what we're trying to do is actually measure the cash outflow that people are experiencing. And so the removal, in my view, the removal of mortgage interest payments from RPI to create CPI was wrong. They shouldn't have done it. And again, it's a manipulation of data to achieve the desired outcome rather than trying to reflect what's actually happening to people.
Well, I think they should have included rents, Richard, not mortgage interest payments, because it does create this. What are you trying to measure in inflation? It's cost of living, and I think in the market, and by including interest rates, which mortgage payments, which are a function of the Bank of England's base rate, then you create this feedback loop, which I just don't think is very helpful. I think including market rents is better.
Yeah. So I think probably you should have a combination of mortgage payments, interest payments, and market rents, and it should be calculated on the basis of how many people rent versus how many people are paying a mortgage. But I think, yes, you have got a feedback loop, but that's not the point, because the point is you can't say we have inflation, we're going to do something to affect inflation, and we're going to remove that effect, the effect of our effect on inflation. I mean, that's just logically inconsistent, and it gives people a free pass, actually, because it says you don't have to, the consequence of your action is zero.
Well,
but the consequence of your action is not zero. The consequence of your action is very important to some people.
Well, but the potential effect, Richard, is that by including mortgage interest payments in RPI rises as you increase interest rates, which means you need to increase them more. And so it increases the volatility of interest rates.
It does, but it reflects the reality. And one of my concerns about much of the data that we are fed is that it actually is deeply manipulated, and wrong decisions are made on the basis of it.
Yeah, well, I don't disagree with that. It's just in this case, I think getting rid of mortgage interest payments is a good thing. And this is the difference between the two. And RPI has, on average, been 0.8% per annum higher than CPI. So really quite substantial. If you hold index-linked gilts, that is quite a nice little yield uplift, frankly. And this is the cumulative difference between the two. So I actually downloaded the data from the ONS and calculated the difference. So in summary, RPI is no longer considered a national statistic. And is it a coincidence that it's up by around 0.8% compared to CPI? So moving from RPI to CPI is going to save the government quite a lot of money in terms of index-linked gilts and indexation all going forward. And the reason that RPI is higher than CPI is that it doesn't allow for substitution effects. It represents the preference basket, not the consumption basket. And that is a philosophical point. You can read the rest. Right. Anyway, on to Recession Watch, Richard.
Thank you, Keith. I thought that graph of RPI versus CPI was fascinating. Well done for pulling that off. And I would just like to say that if you were a mortgage payer over 20 years, you would have experienced something much more like RPI than CPI.
Yeah.
However, not that I wanted to have the last word. So US real GDP growth, Wells Fargo are forecasting a short sharp recession in second half of 2023. And with unemployment rising only briefly, but by about 2% or so.
Yeah, that's quite substantial, actually.
Yeah, it is. The Atlanta Fed thinks that the US economy is doing fine in Q1, and that it's going to the GDP now estimate is on an upward trend.
Yeah, and above 2%.
Which means the Fed will be looking to raise interest rates even more. So historically, there's quite a close correlation between loan standards, tightening loan standards, and rising unemployment. And on that basis, we would expect to see unemployment significantly rise over the next few months.
I think this is a really important chart, actually. Banks have started to rein in loan growth. So they're tightening. We had a chart last week showing they were both increasing their credit spreads and reducing loan availability.
Yeah. And so this is last week's non-farm payrolls data, which is very strong. And the household survey reported much lower jobs growth.
Yeah, we're getting quite a lot of contradictory data. I'm very suspicious of that number.
Yeah.
The non-farm payrolls. I think it's exaggerated.
There were a lot of seasonal adjustments in that non-farm payrolls figure. And
yeah.
I mean, we debate seasonal adjustments till the cows come home on it, which we want to do. But there's been little growth in full-time employment in the past year. So that suggests there's a slowdown in some sort of slowdown in the jobs market. And the ISM being less than 45 has always coincided with negative payrolls figure. ISM is now 47, and the payrolls figure is plus 517. So if the ISM continues to fall, which we expect it to do, at some point we would expect to see payrolls drop down. US business confidence has improved in the last 2 months.
Yeah, the only component still falling is home builders.
Yeah. And the S&P Transportation Index turned positive, which suggests that recession is not imminent.
Yeah, so the transportation sector has always been a good leading indicator. You see it was trending down the whole last year. Well, now actually it's stabilized and been trending up.
Yeah. And if you think Google search patterns are a good indicator of what's going on with the economy or what's going to happen to the economy, Americans are less worried about it, or it may be that they've just found out what they needed to know.
Mm.
Citigroup Economic Surprise Index is showing not many surprises.
Yeah, but it's turned positive. I mean, the thing is, it has turned positive. It's not a huge positive, though. And the market seems to have gone off to the races on the back of that.
Yeah. I mean, it's in the noise range at the moment, isn't it, I think?
Yeah.
ISM PMI is falling towards an imminent recession. So there you go. The PMIs are suggesting we're heading for a recession in the US.
Yeah. Who drew this black line, and how do they know we're 1 month away from a recession? But still.
And as we've discussed really throughout, we got some mixed signals. It's unclear. We believe that it's heading towards recession, but the signals, the indicators are not yet definitive.
Yeah. In particular, and we'll come on to this, there's a huge difference between what the bond market's saying and what the equity market's saying.
Yeah. US manufacturing output is in decline again. And Eurozone coincident economic indicators have turned negative, but leading indicators are more positive. The European Commission believes all sorts of things, including a soft landing.
Yes.
And we still have in the UK some excess savings from the pandemic, should continue to support economic activity for some time to come. Chinese exports falling year on year, and I just look at this chart and it goes back to 2020. So
yeah,
be nice to see this over a much longer term, wouldn't it?
Yeah. Now this it's data to December in the case of the US and November in the case of Europe.
It'd be nice to see it back to 1990 or something like that to get a feel for what's actually happening. South Korean exports have been falling, and they are a good indicator of the health of the global economy. So as it says here, the crisis is yet to be determined, but clearly there's a crisis in the offing if you follow this.
Well, things, at least we're getting consistent data, Richard. So we're seeing falls in Chinese exports and in South Korean exports. But, there has been this blip up recently. Is it going to recover? Is the strength in the world economy in January going to follow through? I mean, I don't think it can, but, I've been wrong so far.
Yeah, I agree. Semiconductor shipments are falling, and that's quite interesting because that, I would say, is a good leading indicator of economic activity. Probably one of the best that we have. Just thinking about it. Supply chain pressures are easing, but are still historically high, and that suggests that they have an input into inflationary pressures as well.
Yeah, exactly. So we've been talking about how goods inflation is falling, but there are still supply chain problems.
A bit of a bounce in economic activity in January, unexpectedly, I think, and a bit of a gain in consumer confidence. Global trade measures are declining, and we've got a significant tightening of lending standards throughout the global economy, or the developed world economy. So, which we think will lead to a slowing economic activity and potentially a hard landing.
Yes. And now a macro update. Now, every week we talk about the state of the global economy, and currently the situation is very uncertain. Now, I look at the data and I think that the world economy is slowing, that all the lags from the rise in interest rates will feed through into a recession in the second half, which will bring inflation down. And then as inflation comes down, the Fed will need to cut rates hard to stimulate the economy. We're going into a normal business cycle. But equity markets seem to completely disagree with me. Equity markets think actually we will survive without a recession, and they have been doing well recently, and in particular, cyclical sectors have been doing best. So when you look at the bond market, yield curve inversions are a very good historic indicator of a coming recession, and the 2-year minus 10-year is deeply inverted and forecasting recession. Now, what if it's not? What if it's actually just forecasting interest rates coming down without a recession? And that's something we should bear in mind. But equities are the other way around. Equities, cyclicals, are doing better than defensives. And that indicates that the equity market thinks that the world economy is actually improving and can survive higher interest rates. Please pause and take a look. So this is from Nordea, and it's model of the US GDP and the euro area. And what it's saying basically is that it thinks that a recession is coming, but it will be later and deeper than the equity market is anticipating. And that's where I am. I agree. Now, the reason the weekly is what it is that I play the cycle, and I therefore am very interested in macro data that will tell me where we are in the business cycle so I can position the portfolio to play the cycle. Now, the equity market is currently in completely disagreement to the bond market. The equity market believes that we're going to have a soft landing. Sentiment data has turned positive. Activity data has turned positive. But leading indicators may have turned up, but they still remain in negative territory. So it seems to me the equity market has been extrapolating hard from a small uptick. I just don't believe a soft landing is possible when the US is committed to raising interest rates to get inflation under control. And we showed you earlier that chart from the San Francisco Fed, which shows that actually higher interest rates has as yet had no impact on inflation in the US. I expect it to do so over the coming months and to slow the economy. Bottom line, as long as central banks remain committed to bringing inflation under control and raising interest rates, I think a recession is inevitable.
So we're now going to have a little look at Chinese residential investment, bearing in mind that China is the second largest economy in the world after the United States. So what goes on in China is important. So Chinese property is very expensive by international standards. And there you can see Shenzhen is the blue line at the top, and Beijing and Shanghai are the orange and green lines. So the house price to income ratios are much higher than they are elsewhere. So real estate investment has been a huge percentage of the Chinese economy over the past 2 decades, and we're all aware of these pictures we've seen of basically cities that have been built with large numbers of blocks of flats, most of which are owned but not occupied, owned as an investment and not occupied, and they're an investment because the price of them keeps going up. So there is a paper gain to be had. And look at China is nearly 30% real estate investment, nearly 30% of the economy, versus between 10 and 20% for other large economies. So, for example, in 2021, real estate investment in China was estimated to be 25% of GDP or more, whereas in the United States, it was around 4.5%. So you get this picture of the huge dependence of the Chinese economy on real estate investment.
I should clarify this, actually. That 4.5% is for real estate construction in the US. And I see from the figure down here that it's actually 17.3% is the equivalent Chinese figure.
Okay, good point, Keith. So US residential investment is much lower, as this shows. So although we consider the US economy to be quite dependent on the residential property market, it has nothing like the exposure the Chinese economy has to it.
Mm.
And one of the things that's been happening in China is these property companies have been selling floor space prior to its construction. And the purchasers have been taking out mortgages to purchase uncompleted property, which has cash flowed the builders. And if that process stops, then the builders hit a cash wall very quickly. And you can see these charts show that completions relative to floor space under construction are actually relatively small, relatively low. And it's a different model. So the model here basically is you might pay a deposit of a few £1,000s to secure a new build, but you wouldn't draw your mortgage down in tranches. Your mortgage would be given to you once the property had been completed.
Yeah.
And security would be obtained by the lender on the completed property.
Yeah. So the gap between the two lines represents money paid by Chinese consumers to Chinese construction companies for properties that they haven't received. And so there's an enormous amount of money that Chinese property companies need to spend to basically fulfill their commitments.
It has potential to be a Ponzi scheme.
Well, I think it was.
68% of all Chinese homes have been built since 2000, which is enough homes actually that have been built to house 1 billion people, which is like 60% of the 70% of the Chinese population, 1.4.
Yeah, absolutely amazing. So 960 million people.
So where did they live before?
Actually, China remained a rural population, shacks
Yeah.
decaying, houses that hadn't been renovated, ever.
Yeah. So these are some current, or nearly current real estate indicators for China. So we see starts have fallen by 40%, sales have fallen by 30%, and fixed asset investment has fallen by about 15%, all within the last 12 to 15 months, and still falling. Mortgage credit growth has decelerated quite sharply from 2017 and is still decelerating. Medium and long-term loan consumption is probably the one that's fallen sharpest, actually. Will be definitely the one that has fallen most sharply and is continuing to fall rapidly.
Yeah. And the thing is, when house prices are like 30 times income, you need to borrow a lot of money to buy those homes. So loan growth is crucial to supporting the market. So
most of the housing stock is in the tier 3 cities, and the amount of housing stock in these tier 3 cities has grown significantly relative to the tier 1 and tier 2 cities, which also suggests a weakness in the system, doesn't it?
Well, there are a lot more tier 3 cities than there are tier 1 and tier 2 cities.
Yeah, and tier 3 cities, prices in tier 3 cities have fallen very sharply, as opposed to having really not fallen at all in tier 1 and tier 2 cities. It actually shows that the tier 3 cities are the problem.
Yeah.
And it's been contracting since mid-2021. So year on year, house price growth is now negative for new homes. So China has very low personal income taxes, and that goes with low quality institutions. We have quite high income taxes, don't we? But we're blessed.
You're right. Correlation is not a good one.
I read today that Liz Truss is making her first speech.
Oh, God.
Will that has any relevance whatsoever to the quality of our institutions? And Chinese consumer confidence is low and falling fast.
Yeah.
Off the cliff.
Although this is only up to Q3 last year, actually, to be fair.
And hopefully, with the ending of the lockdown, it will be rising.
Yeah.
So we have this issue. You've got the troubled pre-sold housing projects, which haven't been completed. And the question is, how much are they going to cost to actually build out? And the IMF says at the end of 2021, there were 6.9 billion square meters of housing under construction, which is an awful lot. It is 10 years of normal completion activity. And it's like extraordinary, isn't it? And the question is, of course, how are these projects going to be completed? And because of the nature of the funding, a lot of households are exposed by having borrowed money to purchase part payment. Will they ever get a completed unit? Yeah.
Actually, just before we move on, the point about the very low income taxes in China, which frankly I hadn't been aware of, astonishingly low, is that the government is funding itself through land sales.
Yes.
And now those land sales are going to slow or stop. So you could see just a systemic crisis in China.
So in fact, another way of looking at it, Keith, you're quite right, aren't you? Another way of looking at it would be to say that these down payments that have been paid by taxpayers or mortgages are in fact a form of taxation.
Yes, actually true.
So the Chinese economy very heavily dependent on residential construction, which it looks like it's highly unlikely to recover to anything like its pre-pandemic peak. The prices are high by international standards. They are falling slowly, and there is this huge overhang of uncompleted properties that people have put down payments on, which is truly enormous. 10 years worth of construction.
But I mean, fundamentally, if your neighbors have all bought houses that they've never received, and the residential property company comes knocking on the door saying, would you like to buy this off-plan property? You're going to say no.
You are. I know, you are. So it's a real danger for the Chinese economy.
So,
which is a danger to the Chinese political system. Sorry, Keith.
absolutely. But, the point is that the market is, expecting Chinese to reopening to, lead the world economy off to the races. And we don't know. There's a great deal of uncertainty. The contradictions in the Chinese economic model could finally start to reveal themselves, leading to an economic crisis. Now, we've been talking about this, since we started the podcast, and people have been talking about it for a decade before that. But it's going to happen at some stage.
I think the chickens come home to roost, don't they? They always do. You can defer it, but you can't stop it.
Precisely. And once again, US housing. US house prices have fallen as mortgage rates have risen. So the white line is the Case-Shiller house price index, and you see that's actually come down around 12.9% from its peak. And the blue line is the 30-year mortgage rates, which have risen very sharply. But mortgage rates have been falling over the past few months, and that has led to a bit of a tick up in activity in January. Higher rates mean that housing in the US is unaffordable, and you've seen the decline in demand for residential mortgages that we've only seen previously in the Great Financial Crisis. And we showed you earlier the mortgage market index, which shows very low mortgage activity. All because we've had rises in house prices and rises in mortgage rates, which means housing affordability is just way too low. This yellow bar in the top graph shows the ceiling for housing affordability. Anything above this bar, the US just has been unable to sustain. The median monthly mortgage payment on the median house is well above its maximum historic range. Home builder sentiment is falling, construction spending is falling, but construction payrolls, as we've talked about previously, have yet to fall because there's a lot of multi-family building activity which takes a long time to complete. Reminder: the housing cycle is the business cycle. Although construction represents only around 4.5% of US jobs, it's highly cyclical. As the construction sector slows, so non-farm payrolls will come down. And construction sector layoffs lead general layoffs for about 4 to 6 months. So the bottom line is that in order to avoid layoffs in the housing sector, mortgage rates are going to have to come down. 30-year US mortgage rates are currently 2.5% above US 10-year rates. And historically, they've tended to track them very closely. Now, I had not understood this, and I hadn't understood why mortgage rates have tended to come down over the last month. But remember that US mortgage rates are 30-year fixed, but they're repayable at any time. So when you write a US 30-year mortgage, you're including this option to close out the mortgage if interest rates fall, and you can refinance at a lower point. So that means you are including in the mortgage this covered call option on US interest rates. Now, when you price any option, the price of that option is a function of volatility. And what this chart shows is mortgage spreads rise with interest rate volatility. And so what we've had over the course of last year is a big rise in interest rate volatility, which has caused this spike in the spread between mortgage rates and 10-year yields. And so there's now this big premium for mortgages above the 10-year rate. And the fall in interest rate volatility has been responsible for that fall in mortgage rates over the last few months. This is the MOVE index, which shows bond market volatility. You see it shot up last year, it's been declining and is now rising again. And this is the 30-year mortgage rate. It's actually ticked back up as of the latest data today. And so, if house price affordability is to be restored, then mortgage spreads have to revert, which could happen if there's less volatility in bond markets. But given the uncertainty in the economy and over the outlook for interest rates, that looks unlikely. Bond yields fall or house prices fall. And if house prices fall, that's bad for the market. And so the top chart here is US housing starts. Big falls in US housing starts invariably lead to a hard landing. Soft landings occur when the fall in housing starts is arrested. And so the point is, if you want a soft landing, you now need to arrest the fall in US housing starts. And this is US construction spending. So new construction on the left, residential improvements on the right. So construction spending has started to fall. And spending on single family dwellings started a sharp decline. Multifamily is still rising. As Richard talked about earlier, there are lots of ongoing construction projects and their developers are rushing to get those completed. So this is the latest data as of January. New housing starts again falling. Building permits falling. Single family permits falling sharply. Multifamily permits actually holding up, down from their highs. But there's a record number of homes under construction that have yet to hit the market. Though single family construction appears to have peaked, multifamily has not. The surprise is that despite the fall in construction activity, particularly in single family, employment in the construction sector has shown no signs so far of coming down. Now, I don't think that's sustainable. We have seen housing starts are falling, and so at some stage employment has to fall because we have falling sales and there's a lot of new build which is being completed. The ratio of sales to inventory has been rising and is at the highest level since the GFC. And these are single houses for sale. And these are single family homes actually sold. And you'll see that you've got lots of homes for sale, fewer being sold. And at these interest rates and prices, there's just not very much interest, frankly. The little tick up in January, some prospective buyers showing some interest, but very low. And we saw earlier that house prices have started to fall, but there's a long way to go for them to get back to affordability, given the very high interest rates. Although in some places, like in Silicon Valley, you have seen big price falls already. So we think that given high interest rates, high mortgage rates, that a deeper correction in the US housing market is inevitable. And construction sector employment is holding up because that they have structurally short of workers. So we've seen that construction activity is higher than pre-pandemic, but construction sector employment has not recovered to its pre-pandemic trend. And so to get all these uncompleted projects finished, there's still a lot of workers needed. So in summary, the slowdown in the US housing sector has begun. Fundamentally, US homes are just unaffordable at these prices and mortgage rates. And mortgage rates are a function of the Fed funds rate and bond market volatility, and bond market volatility is high, as I know to my cost over the last few weeks. And so unless that comes down, then houses in the US will remain unaffordable. A slowdown is inevitable. And then the US construction sector starts to lose job, and we have a generalized slowdown. And onto other charts, Richard.
Thank you, Keith. So this chart shows that there's a great deal of US corporate debt that needs to be refinanced between 2025 and 2030. And they would like to be able to refinance that at lower interest rates than we currently have. Japan looks like it is getting some wage inflation. And be careful what you wish for.
Well, actually, I wanted to talk about this, Richard. What happens? Okay, so Japan has got enormous amounts of debt. They're doing loads of QE with the aim of getting sustained inflation. Now, they are getting sustained inflation. Yeah, we've seen that the inflation numbers, inflation numbers for December were 4%. You're getting wage inflation. So they've got real interest rates that are very strongly negative, minus 3.5%, because their interest rates are 0.5% on the 10-year. So how does this resolve itself? Because they're now going to have to raise interest rates, which will A, bankrupt the Bank of Japan, and B, surely cause solvency problems for the most heavily indebted government. So how does this resolve itself?
Or do they let inflation rip to effectively reduce the value of the outstanding debt?
Well, but then you have a collapse in the yen and runaway inflation, which we haven't had yet, actually.
I mean, maybe this is the next shoe that will drop in the global economy, that something very nasty will happen to the Japanese economy, because it's certainly set up that could happen.
Yeah, well, we've all been expecting this for literally decades now. So, nothing's going to happen next week, you wouldn't have thought. But it seems that this is something we're going to have to watch. Because because they finally are getting inflation.
And to some senses, the trap, as you rightly say, the trap is high indebtedness and a huge exposure by the government to rising interest rates and high inflation, and you can't square that circle.
It's like they're doing their damnedest to bankrupt themselves. If you get high inflation, the whole country goes bust. But we're trying to get high inflation.
It doesn't make sense, does it? I mean, you can't make sense of it. Something breaks. How badly it breaks, when it breaks, remains to be seen. But the danger is something breaks, and there's a lot of instability around. That's a worrying chart. Here we have a chart shows flatlining business investment in the UK, which we've been aware of for a while now, but basically, UK business investment is too low.
Yeah.
China reopening may have less effect on the global economy than the market is anticipating. Quite a complex chart, this, but I would suggest people have a read of it and work it through.
Yeah, I found this interesting on several levels, actually, Richard. So what it's saying is that Chinese consumers have much lower excess savings than the rest of the world. So the reason we've had this huge boom is that the rest of the world were pumped full of fiscal largesse, which they're then spent. In the case of China, you can see from the middle chart that it's only 3.5% of GDP. But what I found really interesting was the UK. Massive, 12.2%. And
it's all part of our deficit, Keith.
Sorry?
It's all part of our deficit.
Yeah, well, that is true.
Mr. Sunak comes to mind.
Yeah, I know. So all that high quality PPE, was it PPE, was it called?
Yes. Yeah, PPE, personal protective equipment, yeah.
Yes.
Good stuff. No, it's an interesting chart, this.
And so what it's also saying is the majority of that money will be spent at home. So its effect on the world economy could be really limited. So
Yeah.
everyone getting carried away about, China's going to reopen, the world economy is going to take off. No.
Yeah. New offshore wind installations. Wow, look at that. That's extraordinary. China is filling the South China Sea with windmills by the look of it.
Yeah. Amazing. Okay, on to some good news, Richard. Well, good. We've covered over the course of the last couple of years the enormous rise in the price of lithium as the energy transition gets going. People have actually started to buy electric vehicles in size, and there's just limited supplies of lithium because, frankly, we haven't really been looking for it. Well, we're looking for it now, and India has announced it's found this enormous deposit in the Jammu and Kashmir mountains. And so it's gone from having no known lithium deposits to being the second largest lithium holder in the world. So India's reserves now mean that it's got as much lithium as Australia, China, Portugal, Zimbabwe, the USA, and Argentina combined.
Well, I don't know what to say, really. They can now start burning even more coal to power their electric cars.
Yes, very good point. Well, they will sell it to us, so we can burn our own coal to power our electric vehicle fleet. And I thought this was funny. This actually summarizes my own portfolio currently. Right. Equity markets, Richard.
Thanks, Keith. So, not too much movement in the equity markets over the last week. The FTSE All-Share is up 6.7% for the year to date. As we know, the FTSE 100 has done very well so far this year. The stocks are up 8.5% year to date, S&P 500 up 6.5% year to date, and the Nasdaq up a stonking 13% year to date. All of this on the basis that the Fed is going to start easing and we'll start QE, and we will go back to where we were before, where everybody's getting rich on someone else's money. The Hang Seng is down chunky 2.2%, and the topic's pretty much unchanged. Bitcoin had a good week. It's now up 42% on the year, which is a lot. The pound is falling against the US dollar, as is the euro, and the dollar is showing some strength at the moment, up 1.4% on the week. And the VIX is up 1.8% and down 2.6 year to date. I read something about the VIX the other day. We've been looking at that VIX chart, haven't we, as a signal for buying or selling the S&P 500. But apparently there are a lot of intraday options are now being written. Also, end of day expiry options are being written. In other words, you buy the option this morning and it expires tonight. And apparently, vast numbers of those are now being written for people who are obviously taking hugely speculative positions, and they are skewing the VIX index because about 30% of the VIX index is now made up of calculations involving these in less than 1 day options.
Wow. Interesting.
And maybe that indicator is not working anymore, or not working as well.
Yeah. Well, I put on my £1 a point spread bet, and it hasn't worked so far. I'm down about a tenner, I think. Anyway, just or something. I haven't looked actually, but I'm waiting. I'm going to follow the advice: buy above 30 and sell below 20. So I've sold, and I'm not going to close it until it's above 30.
So there we are. Gosh, extreme greed. That's the fear and greed index, which is actually jolly high, and it's just our views. We think it's not.
I should say there is some selection bias in these charts, so that the fact is extreme means it gets in here.
So the US government is spending down the GTA, which means there's more money flowing around the economy, so liquidity has improved, and that might account for a little bit of the rise in the indices.
Yeah, and we did a big section on this, in week 95, which I will spin out as a separate podcast. But I'm just amazed how effective this is as an explanatory variable. Financial market liquidity. It just works. It shouldn't work, but it does.
Yeah, it does, doesn't it? And as we've discussed before, bonds are relatively cheap to equities. Equities going one way, bonds the other way. This historic relationship on which the 60-40 portfolio was built has broken down significantly.
So the earnings yield on equities is just way lower than the real yield on treasuries.
Yeah. Equities and bonds have diverged, and the gap will close at some point, but we don't know when.
Yeah.
And equities have been supported by the rise in central bank liquidity, and as we saw above, the US drawing down the TGA. But and the question then is, has global liquidity bottomed, or will there be more QT and so forth, which reduces global liquidity? And this is global liquidity measured by central bank reserves. China, we know, is going to ease. Japan is still easing, and how does that get into global equity markets?
Well, yeah, I'm deeply skeptical, Richard. I just don't think it does.
No.
If the Japanese QE was leaking into markets, you'd expect the yen to be collapsing, and it's been strengthening recently, although it's been weakening the last few weeks. But there's no sign of collapse, as in Japanese investors are, fleeing Japanese assets and buying American ones and pumping liquidity into Western markets. It's just not happening.
No, I agree. So equities are looking expensive relative to bonds because their dividend yield is low, and bonds are likely to go higher rather than lower over the next year.
Yeah.
And high yield credit is pricing in less than a 20% chance of recession, which to me does not make sense.
No, absolutely. There are huge divergences in the valuations of different asset classes currently.
Yeah. Morgan Stanley forecasting a sharp drop in US corporate earnings in 2023, but then to bounce back hard in 2024. I think one of the things is we seem to be moving into a very binary predictive world where it's all going to go wrong and it's all going to go fantastic. And I'm not sure. I guess it's a consequence of QE, where QE really has had huge impacts, and the market and market participants these days seem to be working on the basis that governments and central banks will do something that will dramatically change. But it doesn't. We've got into this very strange world. 79% of companies reported S&P 500 earnings are down by 23% year on year. So why is the stock market going up? And we haven't yet hit the recession.
Yeah, absolutely. I found this absolutely astonishing. Now, I notice that this is GAAP, so generally accepted accounting practices, as opposed to, your heavily manipulated EBITDA number. So the reality is American companies aren't doing well.
And S&P 500 real sales growth is, basically it's at zero. So S&P 500 real sales aren't growing, just like negative. And 2023 S&P 500 consensus earnings estimates have finally turned negative.
Yeah, but equities are expensive and they're going up. Explain that one to me.
Yeah. People are anticipating, I don't know. US stocks do best when unemployment rate is high, and that's because unemployment rate is high in the depths of the recession.
Yeah.
So what we're basically saying is that we're not in the depths of the recession. We are going to go into the depths of a recession, and don't buy US stocks.
That's right. Exactly. And when unemployment is really low, like it is now, then the annualized return of the S&P 500 tends to be really poor. Yeah.
So this is a chart that shows a correlation between asset classes that did worse last year and do better this year. And meme stocks doing the best. So basically, what this is saying, it's the dogs, isn't it?
Yeah.
The buy last year's dogs.
Yeah. So basically, this rally, it just seems another liquidity bubble to me. There's no sense to it.
And right up in the top left-hand corner, we have meme stocks. I can't know what YOLO stands for.
No, I don't know either, actually. But anyway, that's Carvana and all that lot.
Yeah. And tightening lending standards mean loan losses ahead, as we know, and indicate it'd be a bad time to buy banking stocks.
Mm.
Oh, and NatWest did very well, didn't they? £5 billion full-year profit.
I also saw other banks this week were increasing their loan loss provisions. Yeah.
So this is SoftBank's gain loss on investments cumulative. So it had a net gain up to 2021 of 66 billion from nothing in 2019. And sadly for SoftBank, however, they weren't able to capitalize on that net gain and sell their investments. And they now have reversed that position to a 6 billion net loss.
Yeah. Scratch one up for the cynics.
Who'd have thought it? Is it different this time? Are we heading for a soft landing? Of course we are. Jerome Powell's got the cushions out.
Yeah. Well, the market believes it, Richard.
All matters, Keith.
Okay, on to commodities and energy commodities. And it was a bad week, just generally. So Brent down 2.1%, WTI down 2.4%. Natural gas futures in Europe continue to drift off, down 6.2% on the week, down 34% on the year. Same in the UK. US natural gas futures are doing really badly, down another 5%, down 47% on the year. Coal following natural gas down 45% on the year. Uranium, Richard, up 6% on the week, 6% year to date. Is that finally some sense coming into the energy transition? We hope so.
Yeah, I mean, I think it's the start of a fantastic uranium bull market. But don't rely on what I say. Do your own research.
Yeah, don't stockpile it in your own home, Richard. Give me advice.
Well, it's quite warm though. As long as the pile is concentrated enough.
So last week actually we had an amazing build in the US of 19.2 million barrels. So the US market is very well supplied. That is not the first week of builds we have reported. So this year so far, we're only 6 weeks into the year, we've had a build of 50 million barrels in the US. That's a big number. So it seems like that the US market is well supplied, and that is bearish for oil prices. US crude production was steady at 12.3 million barrels, and there was a bounce in the Baker Hughes rig count, up 10. So it's now down only 12 on the year. This is Brent, and had a good week last week, and is drifting again now. Now, the solid blue line on the left is this year's US inventory levels, and they are building quickly and unseasonably. I take that to be quite bearish for oil prices. And if you look at the individual products, you'll see crude's building, gasoline is building really quite rapidly, and the total is building. Now, global crude inventories are low, but they also appear to be building. Now, Russia has announced that it will cut production by 500,000 barrels a day from March, but reminder, last November, OPEC Plus announced they'd cut by 2 million barrels a day. It didn't have any effect on the oil price. Also, do we believe the Russians? But having said all that, this is US gasoline demand, and it's weekly data, and you'll see that it has been building back. Now, it's not seasonally adjusted, but growing. Brief section on the Permian. So Permian Basin is the one shale area that's still growing, but productivity there is falling. So the average Permian lateral length, so the length of one of these shale drills, is up 23% since 2018, but the average estimated ultimate recovery is down 24%. So you're having to drill further to get less oil out. So that implies that the most productive areas of the Permian have been drilled out. And you can see that further in the initial 30 and 90-day production rates from new wells in the Permian, and they are in decline. And the total estimated ultimate recovery from the Permian as a whole has fallen. The industry is less optimistic about how much oil they can get out of the Permian. So I think the peak in shale oil production is very much in sight. And when that peak passes, I think things get really real for the oil market, because the US has been the marginal producer for the last decade, and the rest of the world has largely stopped investing. The super majors have been making super profits over the last year, and at prices above 60, they all make very good money. You don't need $100 a barrel. They're all making very, very good margins and good returns on capital. Although I noticed BP is quite poor. That's because BP have been investing in low energy return on investment, green energy projects. Over many weeks, we have been talking about the lack of oil industry capex. And this chart from Morgan Stanley tells you exactly why that's happening. So this is the compensation metrics that oil company CEOs have to meet to get their bonus. And number one, free cash flow. Health and safety, number two. Lease operating expenses. So operating expenses, basically. Number three, returns, la-di-da-di-da. Reserves, right at the bottom, hardly mentioned at all. Nobody cares about reserves anymore. It's the energy transition. We're not going to be using oil in, next month. Well, I think we are. So, you see the changes over time. The boards have been prioritizing free cash flow, forgetting about reserves and production. And this is European natural gas futures coming down nicely. That's great for the European economy. And of course, the reason that Europe has got through the energy crisis is because of LNG. Now, last year, despite the Freeport outage, and Freeport is back online now, global LNG volumes rose by 5% last year, all of which was due to Europe. They basically took LNG cargoes from China and everywhere else in the world. And demand is only going one way, because Europe is switching from Russian gas to LNG. So we're going to need a lot more LNG supply to meet European demand if we're going to avoid spikes every Christmas, every winter. This is UK natural gas futures declining, US declining. Now, Freeport was offline due to, I think it was an explosion, is now back online, and it is taking the best part of 300 BCF a day, which is great. But reminder, we showed in previous weeks that the growth in US natural gas production is forecast to be 2.4 billion cubic feet this year. So it's quite marginal. And hence you see the continued declines in US natural gas prices. This is coal following natural gas down, uranium ticking up. Commodities, Richard.
So aluminium is having a quiet year. Cobalt, not a very good year at all, down 8.3%. Copper is up 7.6% on the year. Chromium pretty much unchanged. Iron ore up 8% in the year. Lithium down 11% for the year. So it did have a very good 2022. Neodymium pretty much unchanged on the year. Nickel down 9% on the week, 12% in the year. Tin are now only up 7%, 7.5% for the year. Ferrovanadium 5.4% for the year. And zinc pretty much unchanged on the year. And last week was quite a bad week for the industrial metals, wasn't it, Keith? I'm not quite sure what changed, but something has caused people to move out of them, whether they think that the Chinese reopening isn't going to be as strong. I don't know, but there was a sort of change in sentiment, I felt, with the industrial metals last week.
Yeah, I think that initially the markets tend to overdo things.
Yeah.
I think they just got a bit carried away at the start of the year. But I am struck by the continued strength in iron ore and ferrovanadium.
Yeah.
You know, so perhaps the Chinese reopening is actually doing okay.
Yeah, indeed. So there we have aluminium.
I should just add that all the charts this week are 10-year charts to put things in perspective. And you'll see that on average, although they're well down from their highs, they're still, quite high by historic standards.
Relatively high, yeah. Cobalt. Copper. Chromium. I'm still a long-term copper bull, I should add.
Yeah.
There's iron ore. Lithium, which basically, it's gone up 5-fold in 2 years. Why shouldn't it have a bit of a pause? Neodymium. Nickel, which is on a fairly firm uptrend. Tin. Ferrovanadium. Zinc.
So I think if we have a global slowdown, potentially there's further to fall for all these industrial metals.
Yeah, I think you're right, Keith. Precious metals have had a bad week, and gold is now pretty much unchanged year to date, while silver is down 11% year to date. Platinum down 14% year to date, rhodium 4.5%, palladium down nearly 20% year to date. I don't know what has precipitated this sell-off in the precious metals.
Well, presumably it's just rising US interest rates, rising dollar, amongst other things. Certainly for the precious metals.
Yeah. So there we have gold, which is basically sitting in its quite broad trading range. And investing in gold mining shares has been unrewarding over the past 15 years. So you should have invested in the S&P 500 and done much, much better.
Yeah. Of course, that doesn't mean there's going to be unrewarding for the next 15 years. Clearly tech has been the desired trade for the last decade, but, I think it's a busted flush.
Yeah. And silver, platinum.
And platinum, over the long term, has been a poor investment. Not gold.
Yeah. No, well, it's not really used as it's not used as a store of monetary value. It's not really used in jewelry, and its industrial usages, I think, are falling away slowly.
Right.
Mostly it's catalysts, isn't it? Catalytic converters. There's rhodium and palladium.
See, in both case of both palladium and rhodium and platinum, I think as the energy transition speeds up and we move to electric vehicles, then their market just disappears. The reason that rhodium went through the roof was all down to emissions standards mandated by the EU.
No, I think that's right, Keith. And the fact that Russia is a big producer of palladium doesn't seem to have made any difference to its pricing in a general sense.
Yeah. So this week, thank you, Richard. It was a terrible week for rates. So UK 2-year rose by 30 basis points. The 5-year rose by an absolutely astonishing 56 basis points last week. So the market is now pricing in interest rates being on average 56 basis points higher this week than they were last week. That's an amazing number. And the 50-year rose 16 basis points. So the market has suddenly repriced the whole yield curve sharply higher and is expecting interest rates to remain higher for longer. In the Eurozone periphery, Greek 10 years rose by 20 basis points, as did Italian, and Spanish ones rose by 17. So these are UK interest rates. And reminder that really they didn't start rising until that March last year, February and March last year. And bearing in mind the lags, again, I don't think they've yet really had an effect. And this is 3-month Treasury bill, and it has risen to its highest level since 2017. So the market has got religion. It does believe the Fed now that rates are going to keep on rising. And you'll see that the non-farm payrolls led to a big rise in one-year rate expectations. Whole curve has gone up 50 basis points, although longer term expectations remain well anchored. US 5-year forwards have been pretty stable throughout the whole year, actually. So the Fed retains credibility for its inflation fighting mandate. The ECB is shrinking its balance sheet. It now only holds 60.3% of Eurozone GDP on its balance sheet. Now, I think this is really interesting. So this is different corporate bond spreads. You see that junk bond spreads, i.e. the worst, have come in the most, whereas BBBs have hardly changed. So if we think there's a recession coming, junk bonds look really overpriced. And this is rather a depressing chart for UK viewers. So the chart on the left is debt servicing costs as a percentage of GDP. See, they've shot up with UK interest rates, whereas, and we now have essentially the same debt servicing costs as Italy, despite having only 2/3 as much debt. UK 10-year, that's a nasty looking chart. The last 2 weeks have been awful. UK 30-year, that's a really nasty looking chart. Who's still rising? Who knows where it's going to peak? US 10-year, the same. German 10-year, the same. Italian rising. You notice that the spread between Italian and German 10 years is not blowing out. So market is currently not worried about return of the Eurozone crisis. Greek 10-year also rising, but again, not rising relative to Germany. So any change to your views, Richard?
No. Well, yeah, I mean, I would probably say with bonds, don't buy. Which is not so that, I mean, I haven't got any, so I can't sell them, but I would be disinclined to buy them now because of what central banks appear to be determined to do.
Yeah.
It's a bit like closing the stable door after the horse has bolted, though, Keith.
Well, my portfolio is 50% very high risk bonds, mate. So, Okay, concluding comments. Well, economic activity has bounced in January. Labor markets remain tight. Inflation is falling, but it's not falling as fast as had been hoped, and service inflation seems persistent. Interest rates will need to rise higher for longer to curb inflation, and that is exactly what the market has been pricing in over the last 2 weeks. Now, we think that in due course, those higher interest rates will induce a recession. Richard, what have you been up to this week?
Thank you, Keith. So the last 2 weeks haven't been great for me because of the pullback in precious metals. And the FTSE All-Share has done well. So my relative performance is almost zero, 3.4%. I have doggedly sat on my hands. I've done nothing. I haven't made any purchases, no sales. And I hope that I am reasonably well positioned for a recession, and that's my objective really. And I hope that I am. Time will tell, and I think that's a safe way to be at the moment. I'm certainly not chasing the US markets, and yeah, sitting on my hands. And I have nothing else to say this week, actually. How about you, Keith? What's your week been like?
Okay, thank you, Richard. Well, I had a terrible week. I was down 2.1% as yields rose across the board, and I've had a really bad couple of weeks. 2 weeks ago, I was up 4.3% on the year and quite happy. I'm now down 0.6% on the year and bracing myself, frankly, for further losses. The trends are very much going against me. I play the cycle and I've been way too early. So, unlike Richard, who is just aiming not to lose money this recession, I'm aiming to make good money out of this recession, and the recession ain't happened, and I've lost money. Now, I remain confident, but I'm not adding to my position, so no buys, no sells. Let's talk briefly about a couple of stocks. Well, Rambler, I'm afraid I think it's curtains for Rambler. So shares have been suspended since October due to problems with the financing and the need to refinance the company. Earlier in the week, they announced they had not been delivering the gold from their gold streaming agreement to Elemental Altus. And that really isn't that much. It was only about $1 million worth of gold. And Altus would be well within their rights to demand that Rambler bought that metal in the market for delivery to them. But then today, we had the announcement that they've suspended operations at the mine because of problems with suppliers. Suppliers have lost confidence in them. And shares are suspended. Sadly, I think it's going to zero. And more positive is Petrometad. Now, Petrometad have raised $6.5 million and they're going to drill Velociraptor. Now, I have sold out of Petrometad because they've got this Heron well where they know the oil's there. Chinese oil companies are producing from the same fields, but Petrometad have been unable to get the land permission permits to produce from the field. Now, Mongolia is a very corrupt country. It's 110 on the UN corruption list. And my fear is that Petrometad just aren't greasing the right palms, and they're not allowed to grease the right palms because they're a Western oil company. And I think essentially in order to get the wells done and get rid of all these numerous bureaucratic hurdles which seem to appear whenever Petrometad need to do anything, you need to grease the right palms. And I've come to the conclusion that actually the assets are probably better off in the hands of either a Chinese or a private company, which can grease those palms and actually get rid of these bureaucratic hurdles. So in the short term, they're going to drill Velociraptor, and I'd expect the shares to pop if they find oil. But the company are estimating their chance of success is only around 20%. And I hope by now you've watched our key investment lessons from 2022, one of which is you take that chance of success and you halve it. So that's proper wildcat to me. I'm, skeptical. Now, in the bond market, this is 2071 gilt. It's been drifting lower and lower and lower. I bought it back here, expecting it then to be on this upward slope. It's completely reversed, costing me a lot of money. Is that the bottom? Almost certainly not. I'm expecting it to go lower. I've been too big too early. I play the cycle. But, basically, I think that by the end of this cycle, we will be going back well towards 100. So I'm fishing for big fish here.
I think you're right, Keith. I think it is a timing issue. I think we are going to go into a fairly big, deep recession, at which point clearly interest rates will have to drop substantially. It is a timing issue, and I'm guessing that if you would, although you're hurting at the moment, if you hold for 2 years, you'll probably have done very well out of it. It's sort of sustaining the pain in this period of this unknown duration, unknown depth, isn't it? Which is very difficult to do.
Yeah. And can I just say, Richard, it's great to have you back, because last week I was watching my last week's episode and I think I looked depressed. And that's because I was, I was losing money, and the thing is, I can deal with a loss. That's fine. What is difficult is when it's like drifting off every day. And, you kind of think, I'm going to lose money. And frankly, I'm expecting to lose money before this comes good.
Yeah.
And it's clear I've been too big too early. And I knew that the safest trade would be to wait for the peak in the interest rate cycle. But I was too impatient, too big, and, it's going to cost me money. But at the same time, am I sure that I'll get out of this, ahead? Yeah, I am, actually. And
so my personal inclination would be to enter your trade actually at some point, but not yet. Yeah. And the danger of my strategy is I miss it. The danger of your strategy is you endure too much pain. And,
well,
neither is right nor wrong. It's just you can't. If we could all time and park it perfectly, wouldn't it be fantastic?
Yeah. Well, Yeah. So in the meantime, it's good job you're back, mate, because it's cheered me up.
Thank you very much.
So in summary, it's the life of a speculator is not always fun.
Yeah.
Anyway.
And remember Jesse Livingston.
Yeah.
And
Jesse Livermore.
And remember Jesse Livermore, the famous quote, "I made money sitting on my hands." I mean, that wasn't quite his quote, but
yeah. Well, Jesse Livermore, fantastic speculator. I really recommend his book, Reminiscences of a Stock Operator. He made billions, but remember, he did spend it all and shot himself in the cupboard of a New York hotel. So, if you make loads of money, and I really hope our viewers do, don't spend it all and don't gamble it all away, which is what he did. Every time he made loads of money, he tried to double it again, and eventually he blew up.
You need to emulate him in some respects, but not others.
Yeah. Now, well, what he was really good at was taking advantage of bear markets and, buying at the bottom, selling at the top. Anyway, thank you all for watching. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.